Hello friends, welcome back to the channel. Today we are going to understand how should you follow the bucketing strategy when it comes to the fixed income investments that you have. If you don't have any fixed income investments in your portfolio, this is something to think about and listen to the entire video very carefully, right? Before we begin, why don't you take a moment and tell me what kind of investments you have made in the fixed income space to get an idea and get the conversation rolling, right? So now let us move on to the fixed income bucketing strategy. Before I tell you about this strategy, I want you to understand a couple of things that are very important when it comes to the fixed income investment space, right? Firstly, it is the taxation in the fixed income space. Taxation is different for a lot of different products, so it gets extremely complicated to understand how is each product taxed. That's why whenever you are investing in the fixed income instruments, always make sure that first you understand the taxation and then only you start making the investments, right? Secondly, you have to understand there are different types of risk involved when it comes to the fixed income investments, right? There is a credit risk, there is interest rate risk, there is reinvestment risk, there is duration risk, among other few more risks, right? So this is very important and you should really understand these risks also. Now let us understand what exactly is the bucketing strategy that we are going to talk about today. So in this bucketing strategy, I am going to split your strategy into three buckets. So what I do is I split my own strategy into three buckets. Okay. So first is the emergency fund bucket, second is the core portfolio bucket, and third is the satellite bucket. So we will take these one by one and try to understand how these buckets work and how should you invest in these buckets. So let us first begin with the emergency fund bucket. In the emergency fund bucket, you have to ensure that money is meant to meet your financial emergencies, right? Say for example a job loss or a prolonged sickness, you may need the money immediately, right? So you have to ensure that the money is available immediately and you are able to withdraw it. But then where do you park this money? Probably you park this money in, say, fixed deposits or as cash in the bank account. But what happens, what if an emergency never comes or it comes after 10 years? You will end up losing value on this money, and eventually what is going to happen is, as you lose value, you will have to top up the investments every few years. So instead of doing that, say for example, if you have decided to have an emergency fund of 9 months. So I've spoken about how much emergency fund you should have in this video. So I'm linking it here. You should take a look at it and let me know if you have any questions, right? So say for example, if you have an emergency fund bucket of 9 months worth of expenses, so how should you invest this? I would say take 1 month of cash in 1 month of emergency fund and keep it as cash at home. 1 month maybe as cash in the bank account, and 1 month probably in the fixed deposit. So what's going to happen is you have 3 months worth of expenses which is readily available for you to invest. Over and above that, if you keep the kid in the same places, then what's going to happen is you are going to lose value over time. So it is best to focus on moving it to better places. What are those better places? So probably you could consider debt mutual funds, right? So the advantage of a debt mutual fund versus a fixed deposit is simple, that debt mutual funds get taxed on a long-term capital gains tax basis if you hold on to your investment for 3+ years. If it is less than 3 years, then you're taxed at marginal rate, which is similar to fixed deposit. But in a fixed deposit, you have to pay taxes almost every year versus a debt mutual fund wherein you have to pay tax only in the year of redemption, right? So this is a major advantage of debt mutual funds. So which category of debt mutual funds you should consider? So obviously there is ultra short-term debt funds and short-term debt funds that you could consider. But apart from those, there are a couple of other funds that you can consider. Is something like a conservative hybrid fund or an equity savings fund, whereas the net equity exposure is 10 to 15%. What this will do is this will help your money grow at least with inflation over the longer term, right? Because always remember, even though you are setting up an emergency fund, which is extremely important, this emergency is not going to come soon. It may never come, or it may come after 20 years. Nobody knows, right? So that's why you also have to ensure that the money never loses value. Now, let us come to the second bucket, which is the core fixed income bucket, right? So in this bucket, what's going to happen is we are going to invest for the longer term and use it as a part of the asset allocation strategy for your retirement, right? So what type of funds, what type of investments you can look into this bucket, right? So mainly public provident fund, employees provident fund, national pension scheme, and then long-term mutual funds. So first we will talk about public provident fund, EPF and NPS, and why they make sense. So something like a public provident fund and employees provident fund have a very beautiful tax advantage, which is that the interest that you earn, they earn the enjoy the triple E taxation benefit. But what happens is once you have invested, you obviously get the tax reduction in the year of investment, but the interest that this money earns and at the maturity the proceeds that you get, both are tax free. Obviously there are certain limits when it comes to employees provident fund, which has to be discussed in another video because that will take a decent amount of time. But when it comes to public provident fund, anyways you have a limit of 1.5 lakh rupees per annum. In employees provident fund, the employer's portion is anyways tax free, but the total employer's portion of contribution of employers provident fund plus NPS should not exceed 7.5 lakhs in a year. And if employees portion of the employees provident fund contribution is more than 2.5 lakhs in a year, the interest earned on that money over and above that money is taxable, right? So try to limit it within these limits. So this is about the employees provident fund and public provident fund. Now coming to NPS. So NPS, you get three types of deductions, right? Firstly, if you are doing contributions to NPS as an employee, you get the deduction under section 80C for up to 1,50,000. Now if your employer is also contributing to NPS, then there is a separate deduction of up to 10% of basic salary which you enjoy apart over and above this 1,50,000 limit, which is fabulous and a lot of people don't know. So you should definitely use this. And lastly, you can make another 50,000 contribution for this, which is again over and above these two contributions. So in NPS, all the income that gets accrued every year is not taxable in the NPS tier 1, and also at the age of 60, when the maturity proceeds come in, 60% which you get as a lump sum is not taxable. Over and above that, you have to convert this money into an annuity, and the annuity proceeds are taxable. Now what you can do is, instead of taking the maturity proceeds at the age of 60, you can try to take it at the age of 75, right? So what happens is, firstly, the fund continues to grow, and secondly, the taxation of the annuity portion is deferred because the number of years that you will live after 75 will be lower and the money will be passed on to the descendants. So very good strategy there. Now let us understand the third and final bucket, which is the satellite bucket. But before I tell you about the satellite bucket, one more thing to understand in the core fixed income bucket is you could have long-term mutual funds also, but long-term mutual funds, like you could have a gilt fund, you could have a target maturity fund, you could have a roll down fund, you could have a dynamic bond fund, but all these investments are very complicated and probably you should use the help of an advisor because there are lots of risks associated, which I spoke about earlier in the video. Let us discuss the third bucket, which is the satellite portfolio. This portfolio is not meant for you because you need to take the interest rate calls, right? Where we are in the interest rate cycle and when is the cycle going to change. So basically, the bigger institutional players, take this risk, take this call, not risk, and also try to generate higher returns in the longer term bond funds like a dynamic bond fund, right? So you need to have an understanding of the macroeconomic cycle and the interest rate cycle to make these investments. So ideally, it is not meant for retail investors like you and me, but if you still want to play this interest rate cycle change game, then what you could do is you could probably invest in a target maturity fund wherein whatever the yield that is visible as of today, you will get that yield when the fund matures. Say for example, if a fund is maturing in 2040 and has a yield of 8% as of today, you will get that 8% yield irrespective of changes in interest rates over time, right? But you need to stay invested during that period. Otherwise, if you think that you really know what you're doing, then you could when you think that the cycle is changing, you could split your investments over a few months period so that you can get the advantage there. But otherwise, my recommendation is that I would not do it personally. I would leave it to the experts because understanding the macroeconomic cycle and the interest rate cycle needs a lot of study and also a lot of experience as well. So it's very difficult area to be in, right? So folks, we have discussed three buckets: the emergency fund bucket, the core bucket, and the satellite bucket. If you have any questions, feel free to drop in, ask me at any time, right? You can also email me. Otherwise, if you have any feedback on the video, please do not hesitate to share that as well. I hope you enjoyed this and learned something today. Do not forget to comment, like, share, and subscribe. Thank you so much.